Good afternoon, ladies and gentlemen. Great to see so many new faces coming along to this ever-thriving and growing sector. Stuart, they said, keep to your script, keep to your timings. So as for those of you who know me well, there's two immediate challenges that I have to face. The technology seems to be working, so that's always a good start. As Una said, I've got 10 minutes really to set the scene for the panel debate, which Michelle then is going to chair. Okay, the aim really for this next few minutes is to just try and do some thought provocation, some observations, some bullet points from where we've come from in the last year, and where are we going, what are the issues, and perhaps some of the challenges. What lessons have we learnt from the last couple of years? It's affected everybody in every industry, in every conceivable way, both good and bad. So I've tried to extract as much positivity from this and the lessons that we can apply to our sector, the later life lending sector, as we move forward with confident steps. I'd just like to start just in recognition of the figures that came out from the council this week. £4.8 billion worth of lending, a significant increase in previous years. And as one of our earlier speakers referenced, if we dig into that, that doesn't really reflect a huge growth in numbers of new customers. What it does reflect is that customers are borrowing more money. The reasons they're borrowing it are changing. What they're doing with it, we saw earlier on, intergenerational wealth is one example. And we'll touch on a number of other factors as we go through this next few minutes. But I think it would be remiss if we didn't also look at the product innovation that we've seen at huge levels in the last couple of years. We now have in excess of 700 products just in the equity release market alone. If we were to layer in RIOs and mortgages lent by lenders traditionally, but to older consumers, then we'd see thousands and thousands of products from dozens and dozens of providers, all knitted around the consumer demographic that we all serve. So it's important that we get a holistic picture of that as we move forward as business people. We've seen massive innovation within the product space. So not only the sheer number of products have increased, but the innovation around overpayment. Not too long ago, it was pretty standard, 10% overpayment, that was it. We've seen lenders and products come out that will allow more than that. We've seen lenders that will allow far more servicing of interest, capital repayments, flexibility is coming, and it's coming fast. We've seen changing in redemption penalty terms. 2-3 years ago, I think as a sector, we pretty well accepted that gilt-linked redemptions were the norm, and the one or two products that had clear and concise normal residential style redemption penalties were an anomaly. Well, now those product terms have massively grown. So customers have far more choice in how they repay capital lump sums and interest as they move forward. And interestingly, let's not throw the gilt-linked redemption penalties necessarily to the wolves, because there are situations where customers have recently redeemed older products at virtually zero redemption charges because of that structuring. So don't automatically decry them as yesterday's products. We've seen loan-to-value changes. We've seen high loan-to-value. We've seen sub-3% rates on the low loan-to-value market. We've seen tech innovation, real-time product pricing. We've seen APIs that 3-4 years ago, some of us didn't even know what that meant. But now we see it manufactured into products and delivering massively quicker process. We're still nowhere near where we should be, and we're certainly nowhere near where colleagues in the residential bigger market are, but the traction is now starting to happen. We've seen fabulous levels of trading. One of the things I've always been very proud of and excited by in our sector is the passion from the providers. And I spent many years operating in the residential mortgage market where there wasn't the level of support, granular support, that comes from the lifetime providers in our sector. Residential providers were far more automated in their processing, and that was a good thing because the sheer volumes. But in our sector, because it's been a very small growing sector, 3 billion, 4 billion, 5 billion, hopefully very, very close to touching, and beyond that, we've still got a huge amount of passion from all the providers into training subjects, how to build your business, how to use technology, how to look at the different elements of the advice process. The vulnerability issue, that's a subject that is so critical for all of us in the advice community, and we must make sure we don't just pay lip service to the issue of vulnerability, that we embrace it and evolve and develop it. So that level of training is all very well. There is an assumption, and I do hear quite often, that we sometimes have an unfair expectation of new advisors, and I've met a number of you in the room already today that are coming into this sector. And there's accusations, and I hate the phrase for those of you who have heard me speak before on the subject of dabblers. Dabblers is about attitude, and just because somebody's new and not doing a huge amount does not make them lesser persons and lesser mortals within our sector. It's a learning process. You don't get into a car, having never got into one before, and expect to speed off down the road with no problems whatsoever. But I do sometimes think there's an unfair expectation that advisors should be brilliantly competent on day one, compared with many of you that I know in the room over the years that have spent an entire career building up the knowledge and expertise you need. And going back to the training point, what's really exciting and really good is that so many of you with that experience share it with new advisors. And I see quite a bit of mentoring going on in our sector, and that has to be good for the future. We've seen far more involvement from advisors, and what I mean by that is the profile of our sector a number of years ago was basically level 3 mortgage brokers moving, evolving, morphing into the equity release market. In the last 12 to 18 months, we have seen significant interest from level 4 wealth managers. They're not looking at the decumulation mortgage side of the product. They're looking at it as a very, very good, worthwhile and valuable financial planning tool. Inheritance tax mitigation, pension planning, looking at housing wealth in a laterally thought through process of how it may be used to help consumers. Claire touched on earlier on, intergenerational wealth. How many houses in the booming housing market last year for first time buyers were bought from parents or grandparents releasing money, living gifts to their parents that then moved into the housing market and into the broader economy. So that level 4 interest is now growing by the day and is a big part of the future of our sector. The networks 2 or 3 years ago were quite, as they would normally be, cautious. They had a lot of questions. And a lot of the work that Air Group, for example, did last year was working closely with a number of leading networks and distribution organisations to help give that confidence, give that belief that their members could train to a level of extreme consumer good outcome and competency. So that's really, really positive. We've seen the press coverage. I mean, God, a couple of years ago, if we'd said Martin Lewis was going to be positively projecting equity release as a product, I think most of us would have choked on our breakfasts. But the whole media positivity around our sector, does that mean we can be complacent? No, it definitely doesn't. We can keep getting better. Every day is a school day, as they say. But the actual overall press coverage, which the Equity Release Council monitor very closely, has been brilliantly positive. We've seen a huge expansion in the work that the Equity Release Council do, and I have to pay recognition. I've been involved on a number of things. I was very honoured to be invited to join the Standards Board late last year, and working groups on the competency framework that I was involved in as well. But the massive broad work that the Council has done in recent years, especially in the last 18 months, has to have recognition for how that's going to, as a sector, move us forward. So if you get invited to get involved in the working groups that the Council are running, please join in, because your experience will help. We've seen far better regulatory engagement. I think it would be fair to say that a couple of years ago, the regulator really didn't understand our sector. They understood it from a point of view of flagging up issues around TCF and vulnerability and the older demographic. But when it came to the application of the process, of the advice processes, and how that was manifestly running through from A to Z to deliver the products, I think they would also admit they didn't really have a handle on it. But they're really, really engaging with the sector now, and the council especially. But they're out there, they're asking the questions. We saw their referenced work they did 18 months. I've lost track of timing, but I think it was about 18 months ago now, with the Dear CEO letters. So they've got it on their radar. Is that a good thing? Is that a bad thing? It's good, because they will guide us. We need to make sure that we work with them. Far more advisor support, as I've referenced, from clubs, from lenders, from distribution organisations such as Solo with their later life standards, and so many other organisations. So you certainly can't sit in this sector and say there isn't an opportunity to learn. There are lots of opportunities. Please embrace them. Okay, last couple of minutes. Where are we going to go? There is that closer focus by the media. There is that closer focus by the regulator. Let's embrace it. Let's work with it. Let's work with them, feedback, participate, and be open and honest. I'm actually delighted. One of the other points that I'm going to go on to in a second, that let's not forget here, we have one of the lowest complaint products with FOS in all of financial services. I look on a lot of advisors' websites daily, and I look at the Trustpilot reviews that your customers give you. This is a fabulously welcomed product, and it's transformative. It changes consumer lives. I can't think of another product in my financial services 32-year career now. I've been in pensions distribution and protection and general insurance and mortgages. I've never known a product, maybe close to residential mortgages, where in essence you become the transient provider of the keys to their exciting brand new home as a first-time buyer. That creates the similar excitement. But we have a product that sorts out health challenges, helps kids on the housing ladder, sorts out mobility issues, health needs, care costs, pension planning, inheritance tax, etc., etc., etc. So these are exciting times for this product. I think it's also important to pay reference here, and I've often spoken about this. We must break the silos down together. This is a consumer-centric industry. The older consumer demographic might well have vulnerability issues, but that does not make them all vulnerable. They sit and they read and they digest and they ask questions. But we must, as a sector, make sure that we give them all of the potential answers to their issues and problems. We cannot continue to think in one product-centric area, because there will be complaints that will come at us later on if we cannot evidence, and that was referenced in the FCA work 18 months or so ago. Technology, evolution, revolution, depending on how you want to put it, that's certainly something that's going to continue to evolve, and it has to catch up. When I was mortgage broking 20 years ago, I could do pretty much a full online application in a residential mortgage world, and here we are now in 2022. We're yet to be able to do that in our sector if we look at lifetime mortgages. So that's technology that's already there. It's not innovating, it's catching up. We've seen diversification of distribution, and I mentioned the exciting work now that the bigger distributors and the networks are starting to engage with. We've seen product innovation that I've referenced earlier, and conversations that I've had with providers. There's a huge amount more innovation that's coming down the tubes. And I guess part of that is the bigger the market gets, the more innovation will be driven. The more price wars that go on to keep the sub 3% rates low. The marginalised lenders that sit around the peripheries will innovate, will look to get market share, will bring features to products. Claire mentioned fully flexible mortgage. I can remember Prudential, when they were in the sector 10 years ago, that was one of their ambitions, a current account lifetime mortgage. It's within touching distance, that sort of product innovation, but we have to have a market that underpins the commercial viability to bring those features. So it is a bit of chicken and egg. My final point there was PI challenges. This is something that we're working closely with the council on, and is suddenly starting to affect some of you in the room if you're directly authorised. And we have to work closely with the PI insurers to make sure that they understand the risk, they understand that it's low, and they understand the processes that we all passionately deliver to give them peace of mind to deliver good quality protection and insurance. At the moment, they're having a little bit of a panic attack, and many of you have contacted us to say the premiums are rising or being declined. So we need to address that issue. And just finally, what have we learned? We can adapt. This sector did incredibly well, ahead of the curve when COVID first came in 2 years ago. We changed the legal process. We had the gold standard. We adapted to make sure that we could deliver that robust legal process without face-to-face, where our customers were scared, were concerned, and basically needed still to access the money to sort out issues, an increasing number of issues potentially when COVID came in. We saw valuations move to desktop abilities where valuers couldn't go out or customers didn't feel safe with them in the house. So we saw lenders quickly pivot around and be able to deliver desktop-driven valuations. We saw many companies move their staffing from home. Many of you as advisors worked from home, did Zoom calls. We embraced, God, I wish I bought shares in Zoom 2 years ago. We embraced that technology and we utilised it. And some of you are still using that moving forward to bring families together. Remember, one of the base points is to be inclusive of family members. If those family members are in Australia or New Zealand, somewhere else on the other side of the planet, it's a bit hard to have them sat around the coffee table, but now suddenly it's very easy to have them sat on a Zoom call. But it also has a counter side. We must be aware of potential vulnerability issues that technology use has brought us. And as I touched on just now, we do really have a very clunky, manual-driven, paper-based process. We live in a world where the environment is paramount. We're focused every day on the television, other than parties when they're not in the main news, around the environment and the impact on global warming. And as a sector, we have our part we must play. So how do we cut down the use of paper? How do we automate processes? And our consumers, let's not forget, are very robust. This is a generation that still have been through world wars, Korean wars, financial crises, other pandemics. This is not the first to hit society and humanity. So they've been through those challenges. So I was actually quite warmed in the early stages of COVID about some of the robust sort of blitz mentality that came from the older generation. They literally took it on the chin. We've been here before. We've dealt with worse. We'll deal with this. Maybe some of the younger generation had some lessons to learn. And we've got a very low complaints infrastructure. That doesn't mean we can be complacent. It does mean that we've got to keep learning, adapting, and improving and moving forward. And all the stakeholders in this sector are all working to that common goal. And we've seen from earlier speakers the diversification of why customers are raising capital. Changing reasons, returning reasons. The luxury round the world cruises are coming back in vogue with some of our customer base. But the essentials are there as well, down-paying debt that they're being pursued. Let's not forget, in the early stages of COVID, repossessions were stopped, but that just simply kicked the can down the alley, and now older consumers are under pressure. Okay, hopefully that pretty well stuck to time. I'm sorry if I slightly overran. I'm now delighted to hand over to the panel debate. Michelle.
Thank you. No, didn't stick to time. So I'm I'm one of the new faces in the room. So I just want to say before I open up, and I will be quick, I promise you, how pleased I am to be here and delighted to meet you all. And there's no truth in the rumour that I'm just coming tonight, because I checked with the government guidelines that the party tonight isn't actually a party, so I don't have to declare it. So we're all good. I'm going to open by saying something that I wrote down earlier was UK Finance said, I always love to quote someone who said something earlier, later life is in a really good spot. That's the whole thing I took from all of the data that Callum very kindly gave us. So if I can ask Alison first, what do you think is driving consumer reasons for borrowing via equity release or other later life propositions? And have these reasons changed over the last 18 months?
Well, I think we've seen lots of slides today about the various reasons and the flexibilities of the types of products that are out there. So we see intergenerational lending, we see people capital raising to pay off debt. But for me, one of the biggest things that's driving people to this sector is consumer curiosity. So one of the things that we see that there is absolutely no lack of consumer demand. I work in the Rio market, and all of our research tells us there's consumer demand in buckets. And we've also heard today that there's lots of supply. Where we see a disconnect is helping these customers at the beginning of this process who are curious and want to find out about these products get to the end result. Often we'll find that our customers have spoken to 3 brokers before they find a broker who can help them with the types of products that we offer, interest-only products for over 55s. So I think we all know the reasons inherently, debt consolidation, home improvements, intergenerational lending. But for me, I think the pandemic's given us all more time, and it's given us the ability to think about what the priorities are and to be a little bit more curious about the options that are out there and not to feel shamed about it. You know, my parents spent all of their working life trying to pay their mortgage off, and then the thought of using their biggest asset to possibly enjoy their retirement more is a completely different mindset for them. So I do think we've all got a job to play in that.
And just picking up on, you talked about the Rio piece, and we heard, I think, in Claire's presentation and in Callum's presentation earlier that, you know, perhaps those volumes have been low. And so do you think it really is a viable product given the affordability challenge, particularly on the second applicant? And how do you think this should evolve?
So it's a great question, and I would be lying if I said it wasn't one that I get asked all the time. So if I tell you in terms of the types of business we've written, that 48% of all of the mortgages that we've completed on are joint borrowers. So this whole thing about the death stress, yes, it's a challenge, and that's often due to the historical inequity of how pensions were structured. But the top and bottom of it is, it's all about brokers being curious as well as customers being curious, people being curious to look to see what tools are available to find out if these products are affordable. Because there's some great information out there, very, very simple affordability calculators, maximum borrowing calculators, within 10 minutes knowing if a customer is viable for this. And do we not think a customer's worth 5 questions? A person's worth 5 questions. So volumes have been muted in terms of the levels that were expected. But do we feel happy with the volumes of business we've written? We're just off the back of a record quarter, month on month, record October, November, December. And so it's about getting the word out there and making sure people are aware of all of the different options that are available.
So do you think the market is going to grow? Sorry, just to be...
Yeah, no, I do. I definitely do. I think when we look at the stats that are out there, the numbers are irrefutable in terms of, the ageing population, the amount of housing wealth that's held by older people. I think what we all have a responsibility towards is actually making customers aware of all of the options that are out there to them, all of the interest-only options, all of the interest-serviced options, all of those options where, you need you're too young for the loan-to-value you need in some parts of the market. We've all got a responsibility in making sure that customers are aware of all of their choices that are out there.
And I may come back to you a little bit later around how you help advisors with that. Mm-hmm. So just if you kind of bear that in mind. Paul, hi. I was listening earlier and looking at Callum's data, and he was talking about the rise in the age of the first-time buyer, the rise in the term of mortgage extending, mainly driven by affordability. So do you think that we're seeing a move by mainstream lenders by stealth, let me call it like that, in terms of accepting lending into retirement, and also by consumers accepting it, becoming much more commonplace? So do you think this is now the norm, and if so, what does that mean for this market?
Well, first of all, obviously the average age of a first-time buyer being 35 and that going up over many years, that's a travesty really. So later life lending is helping to bring that down by being able to gift money on deposits, etc. So it's really encouraging. And I think we saw from the slides earlier that 50% of mortgages these days are over the 25-year term. So it is an issue, but I think with the mainstream establishment, I think that actually it is more of an acceptance of later life lending rather than a warm embrace. So I think that that's the place where we need to get to. So I don't think it is quite the norm yet. I think there's a few years to go on that yet, but we're definitely heading the right way.
One of the other things, if I can stick with you, we've heard a lot also about intergenerational money gifting, and pros and cons for that in terms of people understanding what that means, making sure that that's done, and the consequences or the reasons for that are understood, and the right choices for people. But we know, the stats say that. I mean, if we look in the last year, we've seen a huge increase in terms of money coming through from parents and grandparents actually to support deposits on houses. Do you think that that's one of the main things that's fueling the growth in equity release? And what particularly do you see is that having on the impact in terms of broader financial planning conversations?
Really good question. I think that there's a number of reasons why the equity release market in particular is growing. That's definitely one of them. I suppose if equity release and lifetime mortgages and later life lending were on TikTok, it would definitely be trending or viral right now. So it is a growing reason. But at the same time, people's attitudes have changed. Very often in the past, people would be gifting money through their wills after life. Now they want to be doing it and seeing the benefits, gifting with a warm hand really, but watching the benefits and helping their children and grandchildren when they need it most. But then that puts a big onus on the advisor, because the advisor has to make sure the advice is right for the immediate need, where there can be pressures from family. But also, once that money has been gifted, for example, very often the client will never see it again. So we have to make sure that that client is also catered for over the next 20, 30 years.
And Stuart, if I can come to you, in terms of just sort of following up on that, Louise was talking about, helping us understand the broader vulnerabilities that we should be looking at now. And I don't know if you agree with this, but my view is that, we know that older borrowers have more vulnerable characteristics. So in 2021, we saw a move to more virtual alongside face-to-face. Where possible, we saw valuers doing remote valuations as opposed to going into homes, and quite often they would go in and they would see how the customer was living, and that might be a way of picking up traits and vulnerable sort of characteristics in living arrangements. Do you think that digital adoption is actually made picking up those vulnerabilities more challenging, or has it helped? And what kind of recognising this new way of maybe interfacing and communicating with customers, what extra training do, say, advisors need or the market need to recognise that change and the points that Louise was making?
Yeah, I think... Is that working?
Yeah.
I think if you look at it in binary terms, the use of technology or the removal of face-to-face inclusion with our consumers went through some challenges. I think it would be remiss of us not to admit that there were multiple stakeholders that would identify vulnerability. You had valuers that went out to customers' houses that might spot something that flagged vulnerability. You had the solicitors doing the processes within our sector that would potentially flag vulnerability. And as advisors, we were interacting face-to-face with customers in their home environment in many cases, and that would also flag vulnerability. I think then the second part of your question, which is the good news, if we left it at that and only used remote access to our consumers, there is potential huge challenge around that vulnerability worry. But I think going to the point of training, we've been involved in a number of training initiatives in recent months around this subject, and I think for advisors, we've seen a whole raft of work coming out. There's specialists that deal in particular vulnerability issues that are now doing bespoke training events, both virtual reality events and physical now face-to-face events moving forward. So advisors need to embrace those. Organisations and firms need to embrace those. And you need to be able to stand up and be counted and answer that question. Should the regulator say, can you evidence what you are doing to flag up and then deal with vulnerability issues? There must be a process in place. One of the other areas I just finished briefly is the technology use. There is technology out there. We're piloting at the moment a bit of work around use of technology to help flag vulnerability. But that is not going to replace what the interactivity that you achieve as an advising community can glean from customers. It helps. It might flag certain things, but it's not going to robotize you as advisors. But you're right, more training, more awareness, and more process established.
these questions you're not aware of, I'm going off, I've gone rogue, okay, just in case the audience suddenly then get some kind of glazed eyes look at me. So picking up on Esther's question earlier, Alison Paul, you know, if consumers aren't disclosing, how do we get to a point where we know what we don't know? And, you know, where is that emphasis? How, you know, we talked about the Equity Release Council going above and beyond in terms of the regulator, but if there's still an issue, how do we address this?
So before I came to work for Livermore, I did 25 years with a mainstream mortgage lender. And one of the things that we emphatically understood was that customers will speak much more openly to advisors. Because generally speaking, there is this fear of, should I disclose that? Should I tell my mortgage lender about that? Could there be a consequence? Whether there is or not, whether it's a perceived, issue or not. So, in my mind, the whole thing around the vulnerability programme is the part that the advising community has to play in that, because we know that customers will speak more openly with the people who helped them, as Stuart has said, have the keys to the door or remain in their property. But one of the things that we really actively encourage at Livermore is we have a programme whereby we ask advisors to speak to our customers every 12 months, talk to the customer. Don't check on the advice. We know the advice was good. You did that in the first place. Check on the customer and find out if you sense there's any issues. You know, we're all human beings. We can all pick some of this up, and let us know. And then let us know, and then at least we can understand if there could be an emerging potential vulnerability. So I think we all have a part to play in it, and I don't think anyone has the absolute answer, but we're certainly trying to adopt some different techniques and processes. We speak to all of our customers before we issue the offer to them. And that's not to check the advice, it's not to do anything like that. It's just to make sure that the customer has a really full understanding of what's going on. Being old doesn't mean you're automatically vulnerable. You know, we can all be vulnerable at any time. But that's one of the things that we think is really important. And what's fantastic about that is you get such brilliant feedback from the customers too. We get fantastic feedback about the process and the advisors. So that's a couple of the things that we do in terms of helping to make sure we're doing our part in identifying vulnerability.
And Paul, did you have anything to add on that?
So we have a basket of measures that we use to flag up vulnerability, but actually from what Dr. Overton was saying, for us it's really, you can't beat face-to-face advice, being in the client's environment, understanding their situation, and it's all about the soft skills and being able to spend the time with them to unearth. Very often it might take a good few hours to actually get to the root of what some issues are, but it's a few hours well spent. So that, along with, I think, regular contact, as Alison said, afterwards, post-sale, if you like, very, very important.
So, Stuart, do you think that the current advice journey or model for later life lending, equity release, is working? And if not, what do we need to do to change it?
It's working in so many ways. You only have to look at the growth of the sector, and as I referenced, the good positivity that comes from consumers, and ultimately FOS, the regulator. The general mood music is the direction of travel is right. Can we get better? Yes, we can. I think probably one of the big areas is the silos, the product silos. This is a consumer-centric market. Let's look at this from the customer journey upwards. What do they need, and how can we best communicate and consider all alternative products? There are residential lenders out in the market that will do an ordinary residential mortgage for 65, 70, 75-year-olds. To not consider those in the round would deny that customer the opportunity of potentially the right outcome product. So if we have to understand how to record keep, and we have to understand how to bring this more holistic view of the other aspects that sit around the core advice process that we're giving. And I think this is all about record keeping, and record keeping. We need to clearly define what we're talking to our customer about. And it's interesting, just going back to the former point, because it knits in. We have a 65, 75-year-old customer that throughout their entire life we program to think that divulging medical worries and issues and challenges can materially affect them in a bad way. And yet here we have a product that often they get better terms, more advance, higher amounts of money if they need the maximum amount, because they might be medically impaired. So we have to have a broader understanding, and this comes really to coaching skills. Advisors in this community, that I know hundreds of them, one of the greatest skills they've got is their empathetic coaching skills, the soft skills. It's not about interrogating them with a 28-page fact find. You don't learn about your customer, you don't get to know your customer. It's about those soft skills. Many advisors empathise with the phrase that we are paid to be friends to our customers, to learn about them as people, and that's when they'll divulge more of their concerns, their vulnerability issues, recent bereavements, those sort of factors that might be transient, but we have to take into account through the advice journey. And I think we do need to get better at that, and there's some real lessons that the regulators flagged up for us, that the council are working on, that I think we can keep learning and bringing those to the table.
I think the important thing from what you're saying there is that we need to share all of this, don't we? Because it is as a community that we need to address this, not in silos. A final question to the panel before opening to the floor. So, Alison, do you believe we'll see more new entrants or further innovation coming into this market? And who do you think is going to be funding these new propositions and services?
Yeah, that's an interesting question. So I think we saw earlier that we don't believe that there's a lack of demand, there's a lack of supply, which, as someone said earlier, is always a good thing for customers. Do I think that the high street will wholesale move into the market? Not at the moment. I don't believe they will, and the reasons for that being that often there's a considerable fear about an open-ended liability if it sits on your balance sheet. And there's also a lot of business out there that people are already availing themselves of, and there is the misconceived idea that this business is a little bit more difficult. And their systems are all set up to be very, very automated. And so the minute you want to look at something around affordability in a slightly different way, there's normally a 2-year programme of tech development waiting in the background. So thankfully, I don't think that the mainstream market will be moving, the high street will be moving into this anytime soon.
But we may see some disruption.
I think we will do, yeah. I think we'll see some. I mean, obviously, you know, we do see some of the bigger banks have got, Rio propositions out there. We see some of them working in partnership with equity release brokers and lenders. So, yeah, I think innovation will continue. In fact, we'll be doing some of that ourselves next week.
I'm going to have to close this now. So I think summing up from everything that we heard earlier, and thank you so much for all of you, your contributions, I think the word engagement comes through. I think there's more engagement within our market. It feels like we've got some bits where maybe it doesn't rub along exactly as it needs to. Let's work together to feed a need that people have and actually understand that. Certainly where we're seeing a move from decision-making at institutional level into individual level, and the challenge that creates with the runoff of kind of funding coming from DB pensions to other provision, with an advisor pretty much unable to talk about retirement planning unless they ask, do you own your own home? All of these things lend to those broader conversations, and I think it was Callum that said that we need to look across the whole market and understand the implications of changing regulation and changing product design across the whole piece, not just in silos. So I'd just like to say thank you very much to everyone for speaking, for the questions, and over to you, Anna.